So interest rates are a pretty important thing that many people have concern about. We've seen them, of course, rise a lot in the last 2 years. That affects the stock market, affects the housing market, and of course, the cost of borrowing. Well, it'd be nice to be able to predict where interest rates are going to go, and it's actually not that difficult. And this week, I will show you how to do that. Plus, I will do my analysis of the markets, and we'll look at the trade of the week. That's all coming up in this week's Stockscores Market Minutes. So, while central banks determine interest rates, the US Federal Reserve meets, they determine what interest rates will be. Other central banks around the world, the European Union, they all do that as well. The rates that you pay on your mortgage, on car loans, that sort of thing, are really set by the bond market. Now, the bond market takes its lead from the central banks, but the bond market is very good at predicting what rates will be going forward. And in doing so, they essentially establish the rates that you pay when you go to get a mortgage. And that has a big effect on the stock market. In an environment of rising interest rates, most stocks will do less well. They will do poorly in some cases, particularly small cap stocks. There's some stocks that are insulated from rising interest rates. We've seen that in the large cap tech stocks like Microsoft and Meta and Amazon. They've done quite well, Nvidia, quite well despite rising interest rates. But for most stocks, it's a big factor, and that's why I think it's important to understand where interest rates are headed. And of course, if you are shopping for a mortgage or car loans or that sort of thing, then that's also important. So if we can use the bond market chart to predict interest rates, then we can sort of make some planning and also consider where the stock market is likely to go. And we can use some very basic concepts when looking at a chart of the Treasury bond market, the US Treasuries, what the trend is. Are there rising bottoms, falling tops? I'm going to show you a chart in just a moment, and you'll see that it's actually not that difficult. So let's jump into a chart of the ETF for the US 20-year Treasury bond market. The symbol is TLT, and you can see that it started to decline some time ago, back over here on the left side of the chart, but really the dramatic climb began in 2022, January of 2022, when this upward trend line was broken. And so anytime you have an upward trend line broken, then that tends to resolve with downward price movement. And that downward trend has been in place for, really ever since. Now it sort of went sideways for a while in 2023, and then fell off again through the summer of 2023. We had a little bounce back November, December, and then in the last 6 weeks, it's been sort of trending down again. Now, if you recall, the best period of the market in the last number of months was November and December. And that was when the US bond market was rallying, which meant that interest rates were going down. So there's an inverse relationship between the bond market and interest rates. If the bond market is going down, like you see sort of here, then the stock market was likely going down as well because interest rates were rising. Here, the bond market was going up, which meant interest rates were falling. And the reason was, even though the US Fed did not lower rates, it started to talk about the future potential for lowering rates. The expectation was that we would get a few rate decreases in 2024. Hasn't happened yet. We don't know when it will happen, even if it will happen, but the bond market is predicting that it will happen. But I don't think we've got a real solid indication that interest rates are going to start to decline because the downward trend on this chart has not really been broken yet. We can draw a line across these tops and see that we're still in a downward trend. We were in a downward trend back here when the market was falling. And so what we need to see, if you want to sort of get a sense that the market is predicting interest rates will fall, is a break of this downward trend line. And we're close to that now. And what's important is that there's also a rising bottom potentially on this chart. So if you break a downward trend line from a new low, like we did back in November of 2022, that's actually not a real strong sign that the trend is reversing. It's when you break a downward trend after the formation of a rising bottom that you have a trend reversal. So if in the next month, 2 months, we see a break of that downward trend line, having already formed a rising bottom, then the market's predicting that interest rates are going to go down as the bond market goes up, and that will be good for stocks. That will be good for the housing market, and that'll be good if you want to go take out a loan for a new car or home. So watch that. That's the key. It's very simple. If that trend line is broken after the build of a rising bottom, then we've got a trend reversal that likely resolves in an upward movement in the bond market and a downward move in the stock market. All right, let's get into this week's analysis of the stock market, and we're going to move away from the TLT chart and over to the S&P chart. And here you can see the daily chart of the S&P is really rising rapidly. Now, as I've talked about in recent weeks, this rapid rise in the S&P is really driven by a small number of large cap stocks. We call them the Super 7. 6 out of the Super 7, with the exception of Tesla, have done really well. They don't really get hurt by rising interest rates. Apple, Amazon, Nvidia, Microsoft, Google, those stocks have been able to do well despite those higher interest rates in the stock market. We'll see in a moment that not all markets are doing this. And in fact, if we were to look at an equal weighted version of the S&P, RSP is the symbol, you can see that even though it's the same 500 companies, S&P 500, this is an equal weighted index, which means all of the stocks in the index have the same weighting. And it has been going sideways over the last 2 months, while the market weighted S&P 500, which is heavily denominated by the biggest companies in it, have been going up. Now notice when the bond market was going up in November and December, look what stocks were doing. So that's why it's so important to understand what the bond market is doing, because it has a big effect on the stock market as well. All right, let's move along now to the NASDAQ market, which is going to look quite similar to the S&P because of that heavy weighting of the large cap tech stocks. Now, if I look at a 3-year chart, I can see that the trend is up. It's getting a little extended. I think it's risky because price has run away from the trend line. So when price runs away from the trend line, it usually comes back to it. Runs away from the trend line, it should soon come back to it. However, we're not going to expect it to come back until the steeper trend line is broken. So see here how that trend line was broken. That started the pullback. Well, we don't have that yet on the NASDAQ. We don't have that yet on the S&P. So there's really no great concern that we're going to get a pullback next week until we see a break of the upward trend. So it remains, bullish. Now, let's take a look at the IWM, which is a broader market index of 2,000 companies. And there you can see how interest rates have affected most stocks. Most stocks have not done well so far this year because interest rate expectations have not been favorable. Again, we had that rally in November and December when the bond market was rallying, interest rates were going down. But more recently, we've basically been down for the year on the Russell 2000 index. Now, what I like this week is that we broke this little downward trend line from a rising bottom. And that tells me that perhaps the stock market is starting to price in some expectations for future interest rate drops by the US Fed Central Bank. Now, we're going to look at a chart of TLT again in a moment. We'll see that that's not really keeping up just yet, but let's watch it next week and see if we get that break of a downward trend line on the bond market. All right, let's move along to the Canadian stock market. T.XIU is the symbol, and I'm going to look at a 3-year chart first. You can see the trend is up, but not with a lot of strength. Certainly the Canadian market has seriously lagged the US stock market. In the very short term, we've got a choppy market with some sideways trading. Had a little bit of a break to the upside on Friday, so that should lead to some small gains this coming week, but not a lot of upside until it hits resistance. What about on the, let's take a look at Gold next, GLD. And there you can see kind of a sideways trading market on the daily chart. It's building what we call a pennant pattern. The trend into the pennant is up, and therefore we expect that the trend out of the pennant will be up. And so although gold has been kind of dead and sideways for the last 2 months, it could and should resolve to the upside with a breakout. Now, if that happens, then this sort of longer term upward trend should continue. However, it's a difficult market to trade because it's very choppy. There's not a strong trend one way or the other. There's not a lot of conviction. And so I think although gold and mining stocks in general look okay, I don't know that it's the greatest place to trade just yet because we don't have a strong trend. How about oil? Now, oil's been choppy the last few weeks, and you can see that we had this break of a downward trend line a couple of weeks ago from a rising bottom. We then pulled back 2 weeks ago, but we held that cycle of rising bottoms, and this week we made gains again. So I think that the oil market is in a process of bottoming, and that should give us some opportunity in oil stocks, which have really lagged the overall market. You know, the oil sector hasn't been doing too well, but we're starting to see signs that momentum is turning. And so I recommend you start to look for opportunities in oil stocks. Don't rush. There is no great rush, but it's starting to turn. Maybe dip a little toe in the water and watch for opportunities in energy. All right, let's move along to some currencies. Start with the US dollar. And you can see the US dollar is rising. And that's because interest rates are strong and it's a safe haven. If we look at the 1 month chart, you can see the trend is generally up in the short term, but the long-term trend is still not great. Bitcoin has been a strong performer. It took a little break through most of 2024, and it started to move up again this week. You see that break. And so the longer-term upward trend, which shows up best on the 3-year chart, is up. It, again, took a little pause for 4 or 5 weeks, but it has resumed the upward trend. I think Bitcoin is probably headed up to this level here on the GBTC ETF. All right, finally, let's take a look at TLT again. You can see the choppiness in the market in the last little while. We had a little rally, which meant interest rates went down. We gave it all back last week. We are at support where price should bounce back. We'll see if it will, but still a negative pattern building. And so we should be careful about how this resolves. I need to see, and again, let's look at that 3-year weekly chart. I need to see this downward trend line get broken from a rising bottom. We don't have that yet. And as I've said, that's really important for the long-term direction of the stock market. If that broader market is going to do well, we need to see this chart start to improve. All right then, my ratings, bullish on both time frames for large cap stocks and NASDAQ stocks. Small cap, neutral both time frames, but starting to improve. Canadian stocks, short-term neutral, long-term bullish, but certainly not with the strength that the US market has. Gold and oil, neutral. US dollar, bullish in the short term, but neutral long term. Bitcoin looks good on both time frames, although I wouldn't chase it here. I think if you own it, it's a hold. Bonds, bearish in the short term and neutral in the long term. All right, now I want to take a look at the trade of the week, because even in a market that's choppy, even when the broader market isn't great, every day there are stocks that do really well for the active trader to take advantage of. I call these alpha stocks. They come alive with abnormal volume, abnormal price action, and you then simply try to take advantage of their breaks of specific patterns. So this is INBS, which on Friday was very abnormal, very liquid, and it broke out from an ascending triangle right here. The reason I'm watching this stock is because it's very abnormal, and just keep in mind, this is a 1-minute chart of what happened on Friday. And so the entry point here, a stop loss down around there, and it went for a nice parabolic run to the upside, making considerable gains. That's something that we took advantage of in my Stockscores active live service. You can learn more about that at stockscores.com. I hope that you've enjoyed this week's Market Minutes. If so, click the like button, leave a comment. Most importantly, trade well.